Luke Gromen, he's the founder and president of FFTT, joining us this morning for a look at currencies. Luke, welcome. Happy New Year. And Luke, is this what you'd expect to see in response to the news of an airstrike, a U.S. airstrike in Iran? You've got the U.S. dollar and the yen bid. The safe haven currencies are on the move higher.
Yeah, I think, and thanks for having me on, Ben. I think in a word, yes. So far, it's been sort of what you'd expect. You've got the safe haven currencies higher, gold higher, oil higher, and so I think let's watch and see from here how things play out in terms of either further tensions or de-escalations, et cetera.
Yeah, definitely a bit of an about face for the dollar after recently testing the 96 level. Luke, throughout most of 2019, we saw a situation where the tail wagged the dog, so to say, as foreign currencies at times appeared to be the catalyst behind dollar bid activity. Do you expect this to continue in the new year? I mean, this kind of the dollar just sort of responding to either the British pound, euro currency, or some of the other foreign markets?
I do. I think really that's you're going to continue to see, I think, that with the interplay of what the Fed does here as we reach the end of the first quarter and see exactly what the Fed does with its balance sheet, which I think will be another key catalyst for the dollar. I think consensus right now is that this is still sort of temporary with what they've been doing with the balance sheet. We're not so convinced that's the case. And so we'll see how that plays out as we move closer to the end of the first quarter. But I think in the meantime, I think that's exactly the right way to think about it.
Luke, let's talk about a couple of the individual currencies that have been on the move and catching my eye. I'm curious to see which ones have really caught your eye. The Swiss franc is one this week to a multi-month high, levels we haven't seen in the franc since October of 2018. Where's the bid coming from? They still have negative rates, if I'm correct. I think they're minus 0.75. Where's that bid coming from, do you think?
It's a great question, Ben. As I was kind of looking through things, getting ready for our appearance this morning, it's because historically, to your point, the Swiss franc has been synonymous with risk off. It's been a safety haven. And obviously, over the last several months, as it's rallied, that's not been the case. And as I thought about it, the short answer is I don't know. And if I had to make a guess, it makes me wonder if we've seen this phenomenon where the Swiss central bank is printing francs and buying U.S. equities in pretty good size. I just wonder if the market hasn't begun to treat the Swiss franc as a proxy to U.S. equity performance. I've not looked at the correlation, but like I said, I don't know why it would rally because historically, like you said, it's been a safe haven. But that's sort of the one thing that jumped to mind is that maybe we're starting to see the Swiss franc start to correlate a bit with U.S. equity performance as a result of what they've been doing in terms of buying equities to manage the value of the Swiss franc.
Yeah, this really jumps out at me when you see the Swiss rallying with the indices into new all-time highs. It just kind of says something's a little out of whack. That'll be interesting to watch this one continue to develop. But it's not just the Swiss, or not just the Swiss franc, the 6S. If you're talking currency products back to levels that they haven't seen since the fall of 2018, how about the bid, Luke, that's come back into the Canadian dollar with optimism tied to the USMCA? Also, the peso, for that matter, has been pretty well bid recently.
Yeah, and it's interesting because it's, again, another one of these non sequiturs, if you will, where along with the Swiss franc, where commodities have, maybe just started to get off the mat a bit, but you've seen this rally in what have historically been, commodity currencies like the Canadian dollar and, to a lesser extent, the New Zealand dollar. The political side would make some sense with the USMCA, and particularly given some of the language in the USMCA regarding foreign exchange rates, which deal in balance of payments, surplus caps, language like that, which would suggest a currency component inferred to those deals. So I think maybe that does have something to do. The USMCA may very well have something to do with the strength in the Canadian dollar over the last several months.
Luke, you briefly mentioned the 6N. I'd imagine some of the bid that we're seeing there comes from some of the concerns associated with U.S.-China trade discussions, the ongoing trade war, resolving at least in terms of resolution and finding a phase one deal. We're seeing expectations for that to be signed January 15th. We're hearing the 6N, this is the New Zealand dollar, caught my eye about a week or so ago as it broke above a key trend line. I'd imagine the 6N, the 6A, these are going to benefit from some of the optimism tied to U.S.-China trade and some of the progress we've seen.
Yeah, I would think so. And I think, again, I would tie back to my comments about the USMCA having FX or currency language in the deal, because Mnuchin said about a month ago or so that the China phase one deal contained language regarding currencies similar to that of the USMCA. And so to the extent that there are these currency-related language, and the way the language reads in the USMCA is like I said, balance of payment centric, and even current account surplus caps, that would serve, if implemented in the phase one deal, all else equal, to put pressure on the dollar relative to the yuan, and then you start talking about sort of the rub-off impacts into things like the New Zealand dollar, and so that would make sense. We'll see if it might be the market starting to sort of discount what currency language might be in this phase one deal.
Yeah, it's been interesting as the indices have been rallying. We're actually pulling up a chart here right now showing the ES to new all-time highs with the dollar coming off. That was another thing that we had been hearing from the Trump administration recently, is how they wanted to see a weaker dollar. Luke, let's talk a little bit about some of the eco data. We've got a couple numbers here today, the ISM non-manufacturing index, we have the construction spending, but I looked even next week for the most part, in addition to some ISM numbers. I think the focus is going to be on the jobs data. It seems like a lot of people are already looking forward to next Friday and non-farm payrolls.
Yeah, I think that's right. That's a big number.
Yeah, let's talk a little bit, Luke, in terms of your thoughts about bigger picture dollar activity. I mean, in terms of the new year, we saw bid activity throughout 2019. Every time the dollar made a new high, it pulled back, but it was pretty steadily on that path to the upside. The most recent move down below in 296 kind of has brought that trend into question a bit. What are your expectations for 2020 in the U.S. dollar?
Our expectations for 2020 in the dollar are weaker ultimately, and the reason for that is I think that we're going to see the Fed, I think consensus is that the Fed will be able to pull back on a sustained basis from what they had to do at the end of the year, and we don't think that's the case. We think it's much more structural than that and tied to U.S. deficits and a dearth of foreign, both central bank and private investor buying of treasuries. And so ultimately, rising deficits and falling or insufficient, we'll say, foreign demand, we think is going to continue to draw the Fed into buying treasuries, growing their balance sheet. And I think at some point, consensus will move from this was sort of temporary, what we saw with the Fed balance sheet since September, to it's more structural. And I think as that happens, that'll probably weigh on the dollar as we move through 2020.
Luke, do you think in 2020 we'll see the dollar reflect a little bit more in terms of what we've been seeing in interest rates? Because that certainly wasn't the case throughout 2019.
In terms of just we're the highest in the world, you mean?
Just the correlation between the dollar and the TNX, for example.
Yeah, I think ultimately, I think it's going to come down to what happens with sort of cross-currency basis. It's been sort of this, weird, treasury rates nominal, and then what are treasury rates doing after FX hedging? Because so much of the demand for treasuries historically had come from the foreign bid, and with cross-currency basis swaps priced where they were, hedges, for the dollar priced where they were, treasuries were not amongst the highest yielding sovereigns in the world. They're actually amongst the lowest. And so I think it will in large part depend upon, what pricing of these FX hedging swaps do for the dollar in terms of what the correlation between U.S. treasury rates and the U.S. dollar do in 2020.
Yeah, which ties us back to our original discussion in terms of some of these individual currencies and the activity there. We'll continue to watch them. Luke, a great breakdown. Appreciate you joining us again. Happy New Year. And traders, that's Luke Gromen, the founder and president of FFTT LLC, helping us talk currencies, the dollar, and reaction to some of the recent activity we've seen tied to these geopolitical events.